Good morning, everyone, and thank you for joining. I'm Taylor Duncan, U.S. Business Leader at Five, and I will be today's moderator. A few housekeeping things before we get started. Questions can be submitted anytime throughout today's webinar by using the chat and Q&A feature. We'll do our best to incorporate them throughout the discussion where appropriate and reserve time at the end for a dedicated Q&A. One thing we're going to try today is by using the voting feature. So as you see questions that you're like, yes, that's a great question, go ahead and give them a thumbs up, and we'll make sure to address the hottest, most popular questions first at the end. Today's webinar is being recorded, so you will receive a link to the recording and a short survey this afternoon before the end of the day. Okay, so before we get started, I just want to set the stage by saying that this is an incredibly dynamic topic. It seems like every day there's another announcement about data centers of unprecedented scale, where they're set to be built, who is pushing back, or like yesterday, what emergency capacity auctions may be required to address reliability concerns. But the questions that our team has been paying the most attention to aren't necessarily where they're getting built or who's building them, but what it means for energy markets, for electricity prices, and ultimately for you as energy buyers. I have had a really fun, challenging time collaborating with my colleagues on today's discussion, but we truly are excited to share what we're seeing across the markets. So before we get started, let me introduce you to the two other experts joining me today. Eric Bratcher, who I'm sure isn't a stranger to most, is Five's Chief Risk Officer and one of the industry's leading experts in retail electricity markets. Eric's career spans the entire history of deregulated power. I get to make that joke because Eric had a milestone birthday this month.
Yeah, thank you, ma'am.
And has deep expertise in retail pricing and load forecasting and helping buyers navigate both the volatility of the markets and the competitive product options. Jon Moore is one of Five's founders, our general counsel, and Five's chief strategy officer. Before joining Five, Jon spent years leading competitive power businesses, including running Constellation New Energy, then North America's largest retail electricity supplier. He also has extensive experience developing and financing generation around the world, which gives really helpful perspective for today's topics. Okay, so I like to think about today's discussion as a roadmap. We're going to begin by looking at how data centers are reshaping electricity demand across the country. Then we're going to talk about who stands to benefit, who ultimately may bear the cost, and then we're going to look at how policy is evolving at the federal, at the state, and even at the local levels before closing with practical steps that energy buyers can take to prepare for what's ahead. So we are going to begin with the demand itself. To fully appreciate what's happening, I think it's helpful to understand the scale. And again, this is something like our team, as we were prepping for this, kept kind of coming back to. Eric, I'm going to ask you a question. What is the historic peak, biggest demand in California?
It's low 50s. I think it's like 52, but that was set like during a heat wave a few years ago. I think their normal peak is like 45,000 megawatts, so 45 gigawatts.
When Eric shared that stat with me, so the peak of the California grid, the CAISO grid, one entire, part of the country, one of our largest producing states, is the equivalent to already the installed operating capacity of data centers in the country today. Already here, already installed. An example that just came up last week that I think was helpful to contextualize the impact that those are having is that there was a transmission fault in Northern Virginia that caused several large data centers to transfer to backup power, and more than 3,000 megawatts of demand came off the grid instantly last week, creating voltage disturbances that were detected all the way to Chicago. A lot of you may have heard that story. And so as we start talking about the demand on the grid that is already here from data centers and the impact they're having, and we're going to shift to what is forecasted to come, those impacts are already being felt. So now let's look at what's planned.
Hey Taylor, I just add
Please.
that also it's not just PJM. I mean, New York, we have clients throughout New York City that are seeing significantly more common voltage irregularities than they've ever seen in the past, and it's tied to the increased amount of demand on the grid as well.
Absolutely.
Absolutely. So one thing on this slide that's important to remember is that these numbers, as mentioned earlier, are incredibly dynamic. This is really just a snapshot in time. In fact, Ohio alone, just that one state, has seen roughly another 10,000 megawatts of announced demand since this data was compiled. We're not focusing too much on the exact numbers, but really following the story of both the pace and the magnitude of the growth that is coming. Another note, and I found this fascinating, is that historically, when these utilities landed large customers, we were talking about manufacturing facilities in the 20 to 30 megawatt size category. Even some of the largest industrial customers on the grid today, like refineries, come in around 100 megawatts. Aluminum smelters, maybe in the 3 to 400 megawatt range. And our largest LNG facilities can approach 500 megawatts. And those are considered enormous, and those often come with their own generation. What we're seeing today is that any one individual data center, that is some of the newer ones that are being announced and projected, are requesting 500 megawatts of capacity alone. Those are not incremental loads. Those are causing the utilities to fundamentally change how they have to plan for the future. So who is driving? Who is driving this demand? I think most people immediately think of companies like Amazon, Microsoft, Google, Meta, and those are absolutely the biggest drivers. Those companies you'll often hear referred to as hyperscalers, but it's not just those companies alone. There's now an entire ecosystem supporting that growth, including AI infrastructure companies or neoscalers like CoreWeave, Crusoe, Lambda, along with the AI labs themselves, OpenAI, Anthropic, xAI. The result is that this demand is being driven from multiple parts of the AI ecosystem, all at the same time. So that brings us to the overall supply and demand issue. Just today, and again, these numbers are constantly evolving, it's estimated that the US needs about 100,000 megawatts of additional supply, so new generation that is not there today, just by 2030. So that's just looking at the near term need that has been identified. And that's not just one single forecast. That's these utilities and these grid operators looking at a combination of projected demand growth, so those new data centers that are coming, the reserve margins that they want to maintain to maintain reliability, and then the reality of not every project that is being forecasted will ultimately get built or will ultimately get built on the timeline that they originally proposed. So just again, one last kind of piece of perspective, 1 gigawatt equals 1,000 megawatts. The project, the kind of example project on the right, is ultimately projected to get up to about 10 gigawatts or 10,000 megawatts. It'll take over about a decade. To put that in context, that one site alone is what the US is saying is about 10% of that additional capacity and supply that we have to go find in the next 3 years. And that number is nearly 10% of the entire United States's current capacity. So the challenge again for regulators and utilities is that they have to make investment decision years in advance before they know exactly which projects will materialize, when they'll arrive, and how much power that they will ultimately require. The last slide for me before handing it over is just kind of a forecast of regional growth. So this chart shows projected data center demand growth by region over really the next decade and how that has moved looking back a few years. One thing that this shows is that the data center conversation of the last few years has really been focused on Northern Virginia and Texas, and this shows that it's no longer just a PJM or an ERCOT story. We're seeing meaningful growth projections across multiple regions. Developers are constantly looking for available generation, like we've been saying, the transmission capacity, and as Jon will talk to, supportive regulatory environments. So with that backdrop, Eric, I'm going to turn it over to you to talk about who stands to benefit, and who ultimately could end up bearing these costs?
Awesome. So yeah, I'd say the kind of one point, I guess, if we could take a thing and grab it and carry it forward through the rest of this conversation, is all of those numbers are massive. They're larger than kind of anything that we've seen as a grid growth, really since the growth of the grid. The numbers, like just the blanket numbers that are coming out of the potential growth in Texas, is something that is in the equivalent of 3 or 4 times the size of Texas alone. That project that we were just looking at, that 10,000 megawatts in AEP in Ohio, all of AEP in Ohio is about 10,000 megawatts. Like the size is massive, right? So these things are just extremely large. They're extremely expensive. The amount of dollars that is required to build the transmission projects or the infrastructure, the generation that's on site, is also extremely impactful. We're going to look at some of these, the impacts of the other players in this grand development of might be one of the largest economic changes that we've seen in the United States since the large industrial revolution, when we talk about the amount of dollars and physical impact and changes that we're seeing around. So we're going to talk about some of the players that stand to benefit and that could possibly lose, other than the direct ones, other than the Amazons and the OpenAIs of the world. Who else are kind of the big players? And so if you kind of think of who might be the winners in this massive growth, it's the utilities. And it could be the utilities that own generation like AEP, or the utilities that don't own generation, that just move the power over the wires like Encore, or the vertically integrated utilities like Dominion or Southern down in the South of the United States, like that's serving Alabama, those that own everything. All of those that stand to benefit, or that are looking to earn a rate of return on the dollars that they spent to build up the infrastructure for a lot of these data centers. If they're guaranteed a rate of return of 9 or 10% on the dollars that they spend, that's a pretty good deal. And the market has absolutely taken notice. This is just the movement of AEP stock price since really late 2023, early 2024, when this became kind of front news. You can see AEP has gone from about $80 a share to almost $140 a share. Pretty large increase of their market cap. And you'll see that kind of across the board on a lot of these utilities that are kind of in the middle of the bullseye. The second group of winners are the generators or the electricity suppliers. So not necessarily the utilities, not the people that own the wires, but the people that own the generation assets or are selling to these people directly. And you could think of those as companies like Constellation, Vistra, NextEra, NRG, all those people that own massive amounts of generation, whether it's they own a nuke and they're just going to sleeve the power from that nuke, or they just own a lot of generation in the areas that they're looking for. This is Constellation's stock price in 2024, late 2023 and 24. It was about $100 to $115, $120. Its high got up to almost $400. So that was about a 4x increase. And just since the beginning of the year, you kind of start to see that retrace. We'll talk about that in a little bit as well. So the generators that are supplying these guys, definitely big winners. Another big category of winners are the people that actually make the engines that make the electricity. So you could think of GE Vernova, Siemens, Hitachi. Those are the big generators, the big, large frame, heavy duty gas turbine generators. Another group that's kind of in the smaller side, because those are such in back order. I think GE listed that they are fully subscribed for 20 orders through 2030 and are now looking at 2031 as deliverables. If you want to order your next power plant, look at 2031 as delivery day. The smaller category are the people that make the reciprocating engines, or the smaller kind of engines that you see these data centers going to and just putting hundreds of them at the facility. You could think those are like Jembach's owner, Ineos, or Caterpillar, or there's a number of those kind of smaller. Some of those are European based, and some of those are United States. Generac makes some of those. So the smaller kind of generation owners and the larger all kind of stand to win, because it's anything that spends type of looking for assets to make this power. The other kind
And
of
there's
category.
one thing I'll add, Eric, is that those smaller generators are getting bigger and bigger as well. So those
That's right.
reciprocating engines are now being sold in 10 megawatt chunks, which was unheard of years ago.
Yes, yes, very much so. The other kind of category winners, the people that actually supply the wires and the boxes and the transformers. You could think of these as like the electric distribution equipment manufacturers. Eaton is a large one that's United States based. Schneider's another large one. These are the people that are selling all the equipment that all the electricians need to actually plug all of this stuff in. They too have seen quite a large run up in their stock price since 2024. Uh, the other winners, the state and local taxing authorities. Uh, the anytime you build a large project that has a very large property value, and some of these projects are extremely expensive. Uh, a large data center, a large data center historically could have been $1 to $6 billion. Some of these extremely large ones that we were just talking about up in Ohio, that 10,000 megawatt, they're talking about 250 to $500 billion as a project. So it's not all property value, but there's a lot of property value there. That's an extremely large taxable revenue for these entities, whether it's the state or the county, or almost anything that allows you to see this property value is increasing your taxable value. So that is absolutely a winner. Moving on to the people that might not be winners in this category, all of the industries that are competing for resources, the same resources that these AI data centers are. So you could think of these like people that are also looking for the direct commodities that these are consuming: the electricity, the water, the natural gas. You could also think of the people that are competing for transformers or almost anything else that these large equipments need. The grids and the ISOs are, I would probably consider, a loser in this instance. You didn't really hear too much more than 2 or 3 years ago of the overall conversation around the incompetency of PJM or some of these ISOs. They are absolutely in the middle of the bullseye of not being able to structure or move a grid fast enough to make this work. So there's a lot of scrutiny and a lot of conversations about redoing a lot of the work that we've built 25 years and kind of building up these grids or ISOs post deregulation. The regulators, the people that are trying to make the rules around these things, are having a very hard time keeping up with the extremely fast changing dynamics, especially if those regulators are in competing states. Then you're kind of shopping around where these large loads can go, and they have kind of drivers on both sides. They would really love to have all of that taxable revenue in their state, in their county, in their city, but they also have a lot of problems about what does that do to the voters in that city, right? So they're absolutely conflicted. And then they're utility ratepayers, whether it's paying for the water or the electricity or anything else that entity is consuming. That's obviously an increase in demand, and if you are also competing with them, then that could be a pretty big driver to your cost as well. You're seeing a lot of that conversation going around as of late. So that's kind of just a non-direct or indirect winners and losers that we see from this, and kind of get an understanding of where that money might lie as far as the winners and losers and who's pushing what. Moving on to kind of the regulated side of the world.
Awesome. Thanks, Eric and Taylor. Yeah, there's a lot certainly happening, on the industry side, and certainly a ton happening on the regulatory side as well. And I've been asked to discuss how federal, state, and local regulation could impact competitive energy markets, and it's certainly just as dynamic as what we're seeing on the development side as well. But before looking at these regulations, I think we need to step back a bit. The U.S. energy regulatory system, sort of as Eric was touching on, was not set up to handle load growth of the volume and at the speed described by Taylor. In fact, our regulatory regime and our electric and natural gas grids were built in the expectation of slow and predictable growth in demand. And even in times of slow growth, the system is pretty challenged. The current regime goes back to the Federal Power Act, which was passed in 1935 as part of the New Deal. The Federal Power Act was drafted to address utility monopoly behavior and give the federal government additional power over the sale of electricity in interstate commerce. But to preserve state authority, the act left states in charge of retail sales and the siting of power plants. These rules were drafted in the midst of the Depression, when the internet and AI were obviously unimaginable. Yet that basic regulatory structure, established in 1935, is still the one we have today. So there's some problems. The federal government still regulates the interstate transmission of electricity and natural gas, yet each state independently controls the permitting of power plants and the transmission of electricity and natural gas inside its border. So everyone gets to play. Adding further complexity, many states have joined regional organizations, and we touched on PJM, for example, to facilitate the operation of their wholesale power markets. Finally, even with all these other regulators, the siting of power plants and transmission or gas lines must meet numerous local permitting requirements, and a developer needs to navigate all of those authorities when facing potential legal challenges at all stages. So we've got to look at data center regulations within this somewhat crazy patchwork of regulations. So let's turn first in the next slide to the federal government. As you can see from this slide, the federal government's position has evolved considerably over the past year or so. President Trump, clearly a developer at heart, was quick to focus on the challenges that the regulatory system placed on developers of data centers. He argued that rules for interconnecting these large loads, whether they were crypto mines or data centers, were not clear, and that the regulatory system moved way too slowly. He was right on both counts. But as voters have increasingly focused on the impact that these large loads have on electricity rates, the Trump administration has clarified that getting data centers online quickly must be done also in a way that protects consumers. The executive agency that controls power markets, or at least interstate power markets, FERC, has echoed the Trump administration's position. And recently, the FERC ordered each ISO and RTO to come up with plans that would clarify the process, both for interconnecting large loads and for doing so in a way that protected customers from bearing the cost of interconnecting these loads. FERC gave each RTO and ISO only until mid-August to show why their tariffs were just and reasonable, and to propose reforms as needed. In March, even going further, President Trump introduced what is referred to as his ratepayer protection pledge, asking hyperscalers and all AI companies to protect consumers from price hikes by bringing their own energy and paying the full cost no matter what. Just last week, President Trump announced that companies making the pledge now include almost all public utilities, almost all the players that Eric mentioned, have signed on to the pledge, all major data center developers, neoscalers, you name it. But it's interesting that the fact that all the president could do is ask people to sign a pledge reflects the real limits there are on executive power over the electricity market. And no matter who signs the pledge, it has no legal authority, and more importantly, perhaps, the siting and permitting of these power plants remains largely within state control. Further, while adding significant demand without increasing retail prices is a great goal, and I think Eric will touch on this later, it's difficult to add that much demand without impacting prices. This obviously is in stark contrast to a country like China or other countries that can use their legislative powers to both set rates and site power plants and data centers. Now we'll turn to, I think it's on the next slide, to Congress. Congress, obviously, with the midterm elections coming up, is sensitive to the impact of data centers on electricity costs. And in a rare show of bipartisanship, a bill supported both by Republicans and Democrats in the House has broad support and is moving forward quite quickly. It also, like the Trump administration, will require large data center owners to pay for grid upgrades. And just recently, this is kind of another interesting take on politics, Ohio Republican Senator Jon Husted introduced a companion bill in the Senate that would replicate what the House is trying to do on these electricity costs. Ohio is, as we show here on the slide, is worth watching closely to gauge the strength of data center opposition. It's a leading state for data center development, and state leaders have historically supported data centers due to the tax revenue, as Eric also mentioned, that they generate. Husted is up for re-election, and his Democratic challenger has made his prior support of data centers an issue, calling Husted the face of data centers in Ohio. Interestingly, now Husted has his name on a Senate bill to address data centers' impact on energy cost. It will be very interesting to see who wins the Ohio Senate race and if Husted's prior support of data centers is a factor in that election. Turning to other states, there's no shortage of state legislation right now focused on data centers as well. While only one state, New York, has passed actually a moratorium on data center development, the most important states to watch are still Virginia, Texas, Pennsylvania, and Ohio. We have those all on this slide, at least some of the key issues in each of them. In each of these states, we see broad-based efforts to address ratepayer concerns. As with congressional action, state efforts now cross all political lines. And a good example of this is in Texas, where Governor Abbott, historically a supporter of data centers and new investment, again for the revenue reasons mentioned by Eric earlier, is now recently sent a letter to ERCOT and to the commission that regulates the utilities in Texas, the PUC, demanding, among other things, that the PUC take action to ensure that data center interconnections will result not just in keeping rates the same, but actually reducing residential electric bills. And they have to do this by July 31st, 2026. So I'll turn it over to Eric. So they got, 3 days? Anything you see happening to
3 days to do the
governors?
impossible? Yeah, I'm looking forward to their results, to their findings.
Anyway, it's I understand the desire to make that happen and wish the governor good luck. But yeah, we don't see it yet. Also, I think what is probably the real wild card out there, and it again fits into the regulatory issues that I mentioned earlier, is community opposition. This includes voter campaigns that focus on zoning rules, public petitions, and all sorts of grassroots actions. This slide lists some of the more material ones, but a recent ChatGPT search says that there are more than 300 communities now that are protesting data centers. And the common themes, and you can see them across the internet, across Instagram, wherever you're seeing common media, water consumption concerns, noise pollution, land use issues, air pollution, obviously the impact on electricity rates, and also the fact that once built, these data centers don't add many jobs. Clearly, and you can see this in almost every day in the newspapers, opposition to data centers is growing at the local level, and we expect it to continue to grow in the run-up to the midterm elections. Turning to the next slide, I think. Yeah, as you can see from this slide, though, the combination of increased federal, congressional, state, and local opposition to the cost of data centers and the focus on retail rates has done nothing to slow the capital commitments to new and larger data centers. For example, OpenAI is projecting to spend something like, and we had a second slide,
there you go.
Even shows how quickly this is all changing, as Taylor said, projecting to spend something like $700 billion on data centers through 2030. But notwithstanding the amount of cash, especially because of the amount of capital they're committing, they also see the winds shifting and are exploring several options to develop new data centers in ways that avoid regulatory hurdles. One way to avoid the patchwork of regulations is to develop behind-the-meter power plants to power these data centers. The generation and use of electricity behind the meter can avoid federal or state energy regulations so long as the plant does not connect to the state or regional grid. There are many examples of these behind-the-meter projects now in operation or in development. Perhaps the best is the project that Taylor was talking about earlier in Ohio. This massive 10-gigawatt data center will be built on federal land and initially powered by a dedicated natural gas plant. The structure, clearly designed to expedite permitting, and we will see what happens. Other examples include two data centers, xAI's Colossus and XAI's Colossus 3 in Tennessee and Mississippi that came online using hundreds of the behind-the-meter gas generators, mostly reciprocating engines that Eric mentioned earlier. Another is OpenAI's Stargate project in Abilene, Texas. Like AI's project, this one will be initially powered by on-site behind-the-meter gas generation combined with local solar and wind. Another option for the data center developers is just to find new states that are more friendly to data centers. Louisiana and Georgia are two of the hottest states for new data center development, and projects in those states include Meta's massive data center in Louisiana and OpenAI's commitment of $20 billion to Project Camellia, a 3.2 gigawatt project in Georgia. Of course, behind-the-meter projects and projects in regulated states are still subject to environmental regulations, as well as local zoning and other permitting requirements. XAI's projects in Tennessee and Mississippi are already the subject of ongoing litigation, and recent reports suggest growing community opposition in Georgia as well. But I would not underestimate these companies' ability to address almost all concerns. They have plenty of money to generate support, and you are seeing all sorts of creative ways to do that. Starlink recently offered half-price internet service in Memphis, and Meta is putting significant capital into workforce training and aggressive marketing campaigns. So long as the capital markets believe in the future value of AI, we will see more and more data centers and more changes to the energy market that regulates and supplies them. And one thing is clear, though, adding this demand without increasing energy prices is a real challenge. So speaking of the market impact, I get to turn it back to my friend Eric.
Awesome. So yeah,
we tried to keep the I theme going, but
Yeah.
there isn't insurance. The punchline is there's not insurance. There's just preparation. So
it's preparation.
Yeah.
So we're going to start in the Texas market to kind of illustrate some of the impacts, the movement of the forward markets, the markets that are doing this. Texas doesn't have a capacity market, so it's kind of sans capacity. We'll kind of show that example second in PJM. But in the Texas market, we've seen quite a lot of volatility over the last couple of years. Let me set up the chart for just a second. This is a look of forward market prices for the calendar years 2025, the blue line, all the way out to 2030, with the right side of the chart being the current price, going back all the way to 2023. And right in the middle of the chart, you see a pretty big knee-jerk spike up of prices that was in the spring of 2024. That was right when this conversation kind of came to a head for the very first time, and ERCOT published massive numbers about the possibility of changing load in the ERCOT market. We then had a pretty sharp fall just a few months later when the market was trying to wrestle with just how fast can all of this actually happen. And where might it happen? It's not all going to happen in Texas. It could happen somewhere else. But then, for instance, the fall of 2024, all the way through about December of 2025, we just had a market that was continuing to be more and more fearful in the forwards of what might happen. You could think of the forward markets as the predictive markets of what the market players are seeing, how they're assessing the risk of the change in supply and demand. The spot market is how the grid is performing right now with what's plugged in. The thing that's kind of helped ERCOT lately is as that fear was growing and all of those forward market premiums kept on saying, hey, there's lots of load coming into the ERCOT market, the generation growth, specifically of solar and battery, has grown also exponentially over the last 2 or 3 years. And the market is wrestling with the fact that the spot price, or how the grid is performing today, is performing some of the best that we've ever seen in the state of Texas compared to the fear of what might come in the future, something like doubling the grid in the next 10 years. You've seen that kind of move the market or kind of separate it. Back in 2024, almost all these years were trading at about the same price. Since this winter, you've seen the outer years, 29 and 2030, sell off just a little bit and recently kind of continued to move up, with 2027 and 2028 selling off a bit. That's the market having that realization of there's a lot of generation kind of growing in Texas in anticipation of this load coming over the last few years. And it's made the current situation look pretty good, but there's still a massive question mark of just how much of this load is going to come. When is it going to come? how is it going to be served? Is it going to be behind these massive, behind the fence self-generation type assets like the governor and everybody's pushing for that would help in the politics of getting this stuff done? Or is more and more of it going to show up to the grid and be grid supported? So the market is absolutely wrestling with those things in Texas, and you're seeing a market that has been quite volatile over the last few years, but just recently is kind of starting to split and not be universal on everything's going to be bad. Shortly, we might actually look pretty good in the short term, but a massive question mark about what's going to happen in the future. I guess the last thing to say about Texas is we've seen massive load growth in just year over year this summer compared to last summer. So as we're going through the summer saying, man, this looks really pretty good as far as how the grid is performing on today's load, the 5.5 or almost 6,000 megawatts of load growth from 25 to 26 does have the market kind of saying, wow, that's a pretty big jump. A 8 or 9% growth year over year is a pretty big number. How much of that is going to continue on a forward basis? Because if it does, or even escalates any more than it already has been, that rosy picture that we're sitting in right now, because we have a decent amount of generation to load ratio, that may evaporate pretty quick if we're growing load that fast.
And Eric, I'm going to jump in.
Yep.
Just real quick to remind folks, because this is really kind of the what we're seeing in the markets, what you can do to prepare, what's actions may be in front of you right now is kind of the last section. Don't forget, if you've got questions, we're going to have time at the end. Go ahead and get your questions in, so that when we get through this, we can make sure that we're addressing the stuff that you're most interested in.
Awesome.
Sorry, go ahead.
Second example that we're going to dive into is PJM. PJM, like a lot of the other markets in the United States, has a capacity market. And the purpose of that capacity market is to look out into the future and anticipate the need for increased capacity or decreased capacity if the grid is slowing down or declining. And it's built to give a price signal to generators of when they need to build more. This is kind of a long-term look back of capacity prices quoted in dollars per megawatt day, which is a weird unit of measure. But you can just kind of see, and this is kind of in the middle of the state of Ohio, back in 24 and 25, the price was $50 to $30 per megawatt per day. Over the last few years, it's clearing closer to $330, $325. That's a massive increase, and it would be higher if it wasn't throttled down or governed by a lot of the governors inside of PJM. The actual market clearing price is about $550 per megawatt. So it has increased, if you let the market do its job and send the price signals, it has increased about 10x over the last 3 or 4 years on the cost of capacity. And that cost of capacity is absolutely the canary in the coal mine, or the first price indicator of a tightening market. This has exploded so much that it's basically been considered broken. The capacity market in PJM and a lot of the other capacity markets saying it's throwing out price signals and throwing out dollar amounts that say build, but the market can't build that fast enough, which means it's an inefficient model. It's no longer serving its primary economic purpose and will probably be significantly overhauled in the short term, just because of its desire, if its purpose is to show prices and to have generation be built when it's needed. Well, right now it's saying generation needs to be built, but it's the prices are too expensive for the public to stomach. So the second piece of that is the actual underlying energy prices in PJM. We saw the same kind of knee-jerk reaction in May of 2024 when everybody was talking, where are these data centers going to come? And it's Texas and Virginia and Ohio and PA. You saw a knee-jerk reaction and then a settling down. And again, similar to Texas, a nice, slow, steady rise. The difference between PJM and Texas, PJM has not had a massive generation growth of solar and battery and the same ratio that Texas has had. And the market is already tight. For the last couple of summers, we've seen a lot of very tight market conditions. Tight meaning the difference between generation and supply, or the reserve margin, is thin. It's very close to one another, and you're seeing continual volatility and escalation in prices. So the difference in PJM, the capacity market is broken and throttled down to a price, and the energy side is really the only relief valve of that throttled down capacity. And we're seeing forward and spot prices in PJM react to that value. So very tight market, very concerned about further future load growth, but already very tight and volatile, is just continuing to escalate. We're really running out of time. We're going to jump into questions because we're already pressing on time, right? I'm assuming I'm seeing your headlines. Yep.
Yeah, there's a couple that's come in, and I do want to just kind of I don't want to say put a bow, but leave folks with, okay, so what can they do, right? So one of the questions that came in, I'll try to weave these in, is how should people be following all of this new news? Like, where do you, Jon or Eric, do you have resources that you would recommend folks use to stay up to date on how this is all unfolding?
The irony of it all, a lot of these AI tools are really good at scraping a lot of these public utility commissions and state regulatories and legislative office. It makes sense why it's so good. We do utilize a decent amount of AI tools to read all the dockets within the public utility commissions and the state legislative bodies and the governors. There's a handful of very good utility-focused websites that kind of publish this stuff, but all the other normal good news sources, the Bloombergs of the world, also publish a lot of this, because 2 years ago, it might have been kind of hard to find news sources. Today, it's the center of the news cycle.
Yeah, I mean, I think there's a lot of news. The challenge is what's going to impact prices, and it's just very tricky to tell. And for example, everyone is focusing on what's the impact on electricity costs, or how to meet all the things I mentioned in the regulatory overview, how to bring on enough power plants. No one's talking about the gas that's needed to
run these power plants,
fire those power plants. Nobody has thought about how much transmission lines you need, or where they need to go, or which gas pipelines need to be built. So I think, again, a lot of things, it's easy to take things on the national level. The real rubber hits the road on the local level, and working with advisors on sort of what your local markets look like is going to be the key.
Yeah. I mean, if you just were to look and say, where is a lot of this large natural gas fired generation going to support data centers? It's near the largest natural gas plays in the United States, the Utica and the Appalachian plays in Western PA and Ohio. A lot of abundant, cheap natural gas there in the Appalachia. And then in Texas, both in East Texas and West Texas and South Texas, has a lot of large natural gas production and production capabilities. And yes, both those areas have generally lower than average price of natural gas, but we'll see massive amounts of natural gas demand over the next few years as we see growth in generation capacities. So good.
I don't know if you want to
start
answer
natural
the
gas producers.
Yeah, a couple other questions that have come in while we still have a couple minutes. So one that just came in, I think is relevant, is in PJM, there's been at least 3 proposals for changing the capacity market. There may have been even more than 3, as put forth by PJM itself. And then there's the reference, and then endless proposed by others. What is your best guess on what model is likely to be adopted, and when should buyers expect those changes to occur?
Yeah, the hardest part in PJM is there's a lot of cooks in the kitchen, and trying to get all the states involved and the FERC approving the methodology. They complain about being slow, but there's just a lot of people that have to approve these things. Most of the capacity markets most of them had a market structure that was similar to PJM's historically, and they've gone away from that and are looking more at a prompt or a short-term capacity market, because forecasting the demand 3 or 4 years out in the future is just extremely difficult to do for these ISOs, and they can bet and lose a lot of money being wrong on that forecast that's 3 or 4 years out. So New England, New York has a prompt month. MISO has a prompt year, so their vision for the capacity market is only 12 months out in the future. PJM is probably going to go to something shorter like that. It's just seemed to be the sentiment. They'll probably break it up instead of having just one capacity market that does the entire year. It'll probably be seasonal at least. So winter and summer, probably maybe even quarterly, like some of MISO is going towards. And then there's conversations about breaking up the capacity market all and making it much less of a requirement to run the market and relying more on ancillary services like the ERCOT market. Not getting rid of the capacity market altogether, but changing how PJM is the clearinghouse of all capacity in PJM. That's kind of not how all of the other markets work. So kind of reducing that capacity requirement in a sense and making it more of a bilateral market. It's really all of those big changes, whether it's a California style capacity market or a New York style capacity market. I think PJM is wrestling with all those of what's the best way to go forward, or even a capacity light model with a whole lot more resilience on ancillary services like a Texas model.
Yeah, I mean, just echo what Eric says there. I think capacity becomes less important over time, and they're using backstops and reliability must-run agreements and other things to handle the volatility.
So I know we're at time. There's still some questions that have come in that I think are worth discussing. So for folks who have to jump, we are going to stick around and answer some of those other questions. But if you need to jump, the recording will be sent around later today, as well as the survey. The survey is super helpful for us to know how can we make these better and more helpful for you. We are here to be helpful for you. And also, if you had a question that you just now thought of but you've got to run, that's a great way to let us know outstanding items we can follow up with you on and answer your questions. Okay, we'll stick around for those who want to for a few more minutes and see what else we can get to here. One of the questions I thought was a fun one was any update on the movement of Elon Musk's proposal of creating data centers in orbit, free power, no water for cooling?
I actually haven't been studying it much, honestly. I've heard a lot of conversations about it, but I haven't studied the economic feasibility of it.
Okay.
I don't know.
Yeah, we don't spend a lot of time looking past 10 years. So, right. Nuclear, I mean, the same thing true with just, small nuclear reactors, and the nuclear issue is how fast. Obviously, if people are able to develop large scale nuclear power plants, at a reasonable cost, that'll have a real impact, and they're a really good fit for data centers. The question will be, and our friend Steve Cass, I'm sure, can comment on it if he's listening, is how quickly can those actually be developed? Can they be done at scale? And it's just outside. When it kind of gets into that kind of technology question, we'll wait and see, but we're at the wait and see for that and putting data centers on the moon or wherever Elon's going to put them.
Yeah. Curious on it was an anonymous question that came in, but is this something, I'm going to read it how it is. Is this something that people should try to follow on like a daily basis and keep up with it? Or like your 401k, just like follow big trends, check it occasionally because it's changing so quickly?
Yeah, I'd probably do the latter. The former, the news feeds for this stuff is constant. You can kind of sense the tide moving by looking at it occasionally, just catching the big news stories. There's definitely been a massive amount of increase in the amount of pushback that we're having, and politicians are absolutely paying attention and moving as fast as they can. It's good that it's an election cycle, right? Moving as fast as they can, or at least appear to be doing all the things in the constituents' best interest.
In response to
exactly.
Constituents.
Yeah. I mean.
Yeah, there's if you try to ingest it every day, there's going to be a whole lot of conflicting noise. The good thing is if you're in tune to a market, whether that's the electricity markets or just the capital markets, those guys are in tune to all the nuanced things on a daily basis. So you can almost have a ticker symbol that you follow, and it will almost give you the indication of bullish or bearish just by where OpenAI is going, or not. Well, they're not public yet, but where Amazon is going, where CEG is going, or Vistra, or some of these utilities. You can just my Google feed has a lot of these things, and we're looking at that all the time to get not only our assessment of the news, but the rest of the market's assessment of that news as well.
And the midterms will be a really good indicator. I mean, data centers, they have all the capital in the world, but they don't vote. And it'll be very interesting to see how much this groundswell of grassroots opposition, whether it's farmers in West Texas or, ratepayers in southern part of the U.S., they really do count. And we'll just see how this plays out. And it's very hard for us to predict, but I would not underestimate the power of voters as well.
One final question. Yeah. One final question that came in from the audience is, what is the 1 to 3 year outlook in PJM for gas basis? Steady, falling, rising?
I would say rising. I'm probably pretty bullish basis prices in PJM. There's a few pipeline. I mean, for the last decade at least, the purpose is to get gas out of PJM and to ship it south to the Gulf and put it on an LNG tanker and sell it to Asia or Europe. That's kind of been the goal of the natural gas industry in PJM, especially like the middle PJM, Western PA and Ohio. The East Coast has always been lacking natural gas supply, so their base has always been very high, but there's been very little appetite to increase that pipeline capacity. There's a couple projects that now are finally moving forward that have been on the drawing board for a decade or more. One is bringing gas out of PA going north into New York, connecting to Tennessee to move it east into New England. And another one is on Transco to just increase the capacity of bringing gas into New York City in Transco. But the rest of it is right there, kind of the bullseye is in the Marcellus and the Utica play, bringing gas either out of Western PA or just burning it right there. And if all of those things, we might see a little bit of uptake in production, but production growth has actually been very slow in the Appalachia region because they've had very little pipeline capacity to move it out. So we've been living with kind of a negative basis in the summer, and even some of those points in the winter, negative basis to NYMEX in a lot of these PJM states for a long time now, and we've probably kind of accustomed to it. That absolutely does not have to stay if you're talking about increasing your burn by 2, 3, 4, or 8 BCF a day coming out of PA. That's a lot of gas.
All right.
Yeah.
It is. Well, we'll wrap this up. I think this is, as far as what's going to make most sense for any one individual buyer is a combination of your own buying horizon, your risk tolerance, what's happening in your region, and the current state of the market at the time that you're looking. So please stay in close contact with your energy advisor. If you don't have a personal relationship with one of our team members, you can always email us at email5@energyby5.com and we will get you connected. And be on the lookout for the link for today's recording as well as that survey. And we'll make sure to get connected and take your feedback into account. Thank you again for everybody for joining. Thank you, Jon and Eric, and our amazing behind the scenes team, Lana Ziegler, Jackie Lichtig. Could not have done this without you. Thank you so much.
Absolutely.
Bye, everybody.
Take care.
Yep.